Last week, Canada's top financial regulator did something they quietly bury in bureaucratic language so you won't notice it. The Office of the Superintendent of Financial Institutions, OSFI, fast-tracked new emergency liquidity rules for every single major Canadian bank, effective May 1st. Your retirement savings, your pension income, your portfolio holdings inside Canadian financial institutions, they are all sitting on a foundation that the regulator just decided needed emergency reinforcement. And while the Bank of Canada is standing at a podium saying, steady as she goes, the people who actually see the real books are quietly boarding up the windows. This is not a drill. This is not a coincidence. And this is already happening. Here's what I'm going to prove to you in the next 30 minutes. First, I'm going to show you exactly what OSFI's emergency LAR update actually means and why the official explanation is covering up a far more serious liquidity problem building inside Canada's Big Six banks right now. Second, I'm going to walk you through the three-layer mechanism that has allowed Canadian banks to hide their real liquidity stress from depositors, retirement savers, and pension holders for years. Third, I'm going to show you the domino sequence, step by step, that leads from this regulatory change directly to your 401k equivalent, your RRSP, your mortgage rate, and your ability to access your own wealth when it matters most. And by the end of this, you will understand why OSFI didn't do this because the system is healthy. They did this because the system is fragile, and they know it. But here's the part that scares me most, and we haven't even reached it yet. To understand what OSFI just did, you cannot start in January 2026. You have to go back to 2008, when regulators around the world discovered something that changed how banks are supervised forever. They discovered that a bank can look perfectly solvent on paper, solid capital ratios, strong earnings, impressive balance sheets, and still collapse in a weekend, not because they ran out of money, because they ran out of liquidity, because the short-term funding that kept their daily operations alive simply evaporated. That's when Basel III was born, a global framework designed to force banks to hold enough high-quality liquid assets to survive a 30-day stress event without government rescue. And Canada, to its credit, adopted this framework through OSFI's Liquidity Adequacy Requirements, the LAR. Here's the part they never put in the official reports. The LAR framework, for all its strength, has a critical vulnerability hiding inside it. It divides liquid assets into three levels. Level 1 assets, government bonds, central bank reserves. Those are treated as the purest form of liquidity. Level 2A assets are high-grade corporate bonds and covered bonds. Level 2B assets are more complex instruments, riskier, subject to significant haircuts. And then, sitting just outside the clean perimeter of these categories, are the instruments OSFI just targeted in January 2026, retail structured notes and partnership deposits. This is the mechanism hiding in plain sight. Retail structured notes are products sold to ordinary households, Canadians with retirement accounts, with savings portfolios, with RRSP contributions. They have been buying these products for years under the assumption that they are as safe as deposits. And partnership deposits, also called brokered deposits, are deposits sourced not from a direct relationship between a bank and its customer, but through intermediaries, third parties, brokers, financial platforms. These deposits look identical to regular deposits on the surface, but they behave completely differently under stress. They are among the first funds to flee when confidence wavers. And now OSFI has decided that the definitions around these instruments need to be tightened immediately, before May 1st. Think about what that tells you. This is not theoretical, it's observable. Think of the Canadian banking system as a three-story building. Level 1 is the foundation, the real hard liquid assets, Government of Canada bonds, Bank of Canada reserves, Treasury bills, cash that can be converted without any loss at any moment. This is where genuine wealth preservation actually lives. Level 2 is where it gets complicated. Corporate bonds, covered mortgage-backed instruments, structured products, assets that appear liquid in normal conditions but begin to behave differently the moment institutional stress appears. Level 3 is where the real risk has been accumulating for years. Brokered funding, partnership deposits, retail structured notes, instruments that look stable in a spreadsheet but carry embedded runoff risk that most depositors and frankly most retail investors have never been told about. As long as all three levels move together, as long as confidence holds, funding markets stay open and no one tests the exits, the whole structure looks perfectly solid. But the moment one actor at level 3 starts pulling their money, the cascade becomes unstoppable. And here is where the first domino falls. OSFI's January 2026 LAR update is not routine housekeeping. Regulators update liquidity frameworks. That's true. But they do not fast-track those updates in the middle of an active trade disruption under an accelerating geopolitical stress environment, specifically targeting the two instruments, structured notes and brokered deposits, that are known to amplify liquidity crises unless they have seen something in the actual risk data that the public has not been shown yet. OSFI's own mandate is preventive stability. They are not in the business of market signaling. They do not issue press releases designed to alarm depositors. They act quietly, technically, and early, always before public stress becomes visible. Here's the detail even analysts tend to miss. OSFI's mandate is specifically preventive. They tighten liquidity rules when they observe market fragilities, not when they forecast them. That distinction is critical. This is not a forward-looking simulation. This is a response to something they have already seen inside the funding data of Canada's largest financial institutions. And they saw it serious enough to move the deadline to May 1st. Not the end of the year, not a phased implementation. May 1st. That is not months away. That is already beginning. For the average Canadian household, what does this look like on the ground right now? It looks invisible. It looks like nothing. Your online banking works. Your mortgage payment went through. Your RRSP statement looks fine. But underneath that surface, in the wholesale funding markets where banks borrow from each other, in the brokered deposit channels where large sums of capital move overnight, in the structured note market where retail wealth is concentrated, the pressure is building. And OSFI has just told every major bank in Canada, you need more real liquidity, you need it now, and you need to reclassify what actually counts as liquid, because what comes next is worse. The trade disruption context is not incidental to this story. It is the engine driving it. Trade wars do not just hurt exporters and manufacturers, they destabilize cross-border funding flows. They increase the probability of sudden stops, moments when international capital stops moving across borders, which hit banks that rely on foreign wholesale funding. Canada's Big Six are globally integrated institutions. They borrow in foreign currency. They fund operations through international capital markets. When geopolitical risk spikes, the cost of that funding rises, the availability of that funding shrinks, and the stability of deposit flows inside Canada becomes the last line of defense. This is not a prediction. The data forces one conclusion. OSFI saw this dynamic building and moved to shore up the buffers before the public noticed the pressure. But that's not the real problem, and we're getting there. Let me show you the math that nobody on financial television is walking you through right now. Under OSFI's LAR framework, Canada's Big Six banks must maintain a liquidity coverage ratio, the LCR, above 100%. That means for every dollar of projected cash outflows over a 30-day stress scenario, they must hold at least $1 of high-quality liquid assets. Level 1 assets, the real stuff, government bonds, central bank reserves, assets that cannot be questioned when confidence breaks. Here is the part they never put in the official reports. Not every dollar sitting inside a Canadian bank's reported liquidity buffer is actually level 1. A significant portion of what banks count toward their liquidity positions sits in level 2A and level 2B categories, instruments that carry haircuts. That means a bank holding a level 2B asset worth $100 on paper can only count $60 or $65 of that toward its regulatory liquidity requirement. The rest is a gap. And that gap is precisely where structured notes and brokered deposits have been quietly sitting, inflating the appearance of liquidity without providing the real thing. This is the mechanism hiding in plain sight. Now, here is what makes OSFI's January 2026 update significant in a way that the press release did not explain. By tightening the definitions around retail structured notes and partnership deposits, by reclassifying how these instruments behave under stress, OSFI is effectively telling Canada's largest banks that a portion of what they previously counted as a liquidity buffer no longer qualifies, or qualifies at a lower weight. That means banks must either acquire more genuine level 1 assets or shrink the funding structures that relied on those instruments. This is not theoretical. This part isn't a prediction, it's math. And here is where it hits your retirement savings directly. The Big Six banks are not passive depositories. They are the primary channel through which Canadian retirement wealth is managed, deployed, and custodied. Your RRSP, your TFSA, your employer pensions bond portfolio, your mutual fund's underlying bank exposure, every one of these instruments sits inside a system that OSFI just told needs more real liquidity immediately. That means the banks will be competing harder for stable core deposits. It means the cost of funding for instruments like mortgages, lines of credit, and investment products will shift. It means the invisible subsidy that has kept Canadian mortgage rates and savings yields in a certain range, built on the assumption that brokered deposits are nearly as stable as retail deposits, is now being reassessed at the regulatory level. Here's what that looks like on the ground for an average family in Canada. A household carrying a variable rate mortgage tied to prime is already watching their interest costs respond to Bank of Canada decisions. But Bank of Canada rate moves are public. They are announced, they are debated. What is not debated publicly, what does not make the evening news, is the quiet tightening of wholesale funding conditions that happens when banks are forced to restructure their liquidity profiles. When a bank needs to attract more stable retail deposits to replace brokered funding, it raises deposit rates. When deposit rates rise, the cost of lending rises. When the cost of lending rises, mortgage rates follow, not because of a central bank decision, but because of a structural funding shift happening inside the bank's balance sheet right now. For the average household with a mortgage coming up for renewal in 2026, this is not an abstract risk. This is a direct hit to their purchasing power and their real estate equity. But that's not the part that scares me most, because we haven't reached the credit stress layer yet. Let me show you the three-part domino sequence that runs from OSFI's LAR update directly into Canada's credit markets, and then directly into the retirement portfolios of millions of Canadians who have no idea this chain even exists. Step 1. OSFI's tightened LAR definitions force banks to reclassify a portion of their existing liquidity buffer. Instruments previously counted as near liquid, retail structured notes, brokered deposits, must now be treated as carrying higher outflow assumptions under stress. The effective liquidity buffer shrinks on paper, even if no actual cash has left the building. This is a reclassification event, not a crisis, but it forces action. Step 2. Banks respond by competing more aggressively for core retail deposits, the most stable, most expensive form of funding available to them. They raise savings rates. They offer promotional GIC rates. They restructure their deposit gathering operations to reduce reliance on brokered channels. This costs money. It compresses net interest margins, the difference between what banks earn on loans and what they pay on deposits. Compressed margins mean lower earnings. Lower earnings mean pressure on capital ratios, and pressure on capital ratios triggers the next level of response. And here is where the cascade becomes unstoppable. Step 3. With tightening margins and higher funding costs, banks begin repricing their credit products. Mortgage rates edge higher, lines of credit tighten, small business lending standards stiffen. This is not dramatic. It does not happen in a single announcement. It happens gradually, quietly, in the fine print of renewal letters and rate sheets that most people never read carefully until the number is already different. For the Canadian household with $200,000 in variable rate debt, a mortgage, a HELOC, a car loan, a 50 basis point increase in effective funding costs translates directly into thousands of dollars of additional annual debt burden. Here's the detail even analysts tend to miss. Step 4 is where the retirement savings layer gets hit. As banks tighten credit and rebalance their portfolios, fixed income markets feel the pressure. Canadian bank bonds, which constitute a massive portion of Canadian pension fund portfolios and bond ETFs held inside RRSPs, begin to reprice to reflect the new funding environment. Duration risk increases. Bond prices fall. For a Canadian retiree holding a balanced portfolio with 40% in fixed income, which is the standard recommended allocation for near-retirement investors, a 150 basis point rise in Canadian bank bond yields translates into a meaningful drawdown in portfolio value, not catastrophic, not overnight, but real and largely invisible to the people experiencing it until it shows up in a quarterly statement. For the average household, this means the wealth they believed was safely allocated is quietly being eroded by a funding mechanism shift that no one explained to them in plain language. This is not theoretical. This is already happening. Step 5 is the structured products layer. This is the part they never put in the official reports. Canadians hold hundreds of billions of dollars in investment products that are either directly or indirectly exposed to bank-issued structured instruments. Principal protected notes, market-linked GICs, structured deposits sold through financial advisors. These products were designed and priced in a funding environment where brokered deposits and structured notes carried a specific cost of capital. When that cost of capital changes, when OSFI forces a reclassification that makes these instruments more expensive to issue and more conservative to hold, the economics of those products shift. Banks reprice them, the yields decline, the lockup periods extend. The fine print changes in ways that most retail investors only discover when they try to access their capital. And this is where the cascade becomes a personal crisis rather than a macro event. For a retiree who placed $100,000 into a 5-year market-linked GIC through their bank's wealth management division, a product that was supposed to provide inflation-linked returns and principal protection, the discovery that the underlying economics of that product have been restructured by a regulatory change they never heard about is not just a financial event. It is a betrayal of an assumption they were never told they were making. Here's what this looks like on the ground at the portfolio level. The banks will not call you. They will not send a letter explaining that OSFI's LAR update has changed how your structured product is funded. They will not host a town hall for their retail investment clients to explain that the brokered deposit channels supporting certain product structures are being wound down. They will manage this internally in their treasury departments, in their capital markets divisions, in board-level liquidity committees, and the retail investor, the pension member, the RRSP holder will be the last to know. By the time the consequence shows up in an account statement, the structural shift will have already happened. But this isn't even the part that scares me, because there is a fifth layer to this system that almost nobody is talking about, and it involves the relationship between OSFI's timing, Canada's current trade environment, and the wholesale funding exposure of Canadian banks to international capital markets. We haven't even reached that part yet, but once we do, once you see how these three forces are converging simultaneously, the reason OSFI moved to May 1st will make complete sense. And the domino after that one is the one that affects every single person in this country, whether they own a single financial product or not. Here is the layer that the financial media has completely failed to connect to OSFI's January 2026 update. And once you see it, you cannot unsee it. Canada's big six banks are not purely domestic institutions. They are globally integrated funding operations. They borrow in US dollars. They issue debt in European capital markets. They rely on international wholesale funding channels to support their domestic lending operations, including the mortgages, the lines of credit, and the investment products sitting inside your retirement portfolio right now. In a stable geopolitical environment, this works beautifully. Foreign capital flows into Canada. Banks fund cheaply. Credit is abundant. Mortgage rates stay manageable. Portfolio returns look healthy. But here's the part nobody expects. When a trade war accelerates, when tariff escalation creates genuine uncertainty about Canadian export revenues, about corporate earnings, about the stability of the Canadian dollar, international capital does not wait for the situation to resolve. It moves first. It reprices risk first. It demands higher yields on Canadian bank debt first. And by the time the average Canadian investor reads about funding cost pressures in a bank's quarterly earnings commentary, the actual repricing has already happened 3 months earlier in the wholesale market. This is not theoretical. The data is unambiguous. Trade disruptions historically increase funding volatility for banks with significant cross-border exposure. Rising geopolitical risk increases the probability of sudden stops in international capital flows. And when those stops hit an institution that has been relying on brokered deposits and structured note issuance to supplement its core retail funding, the exact instruments OSFI just reclassified in January 2026, the liquidity gap that opens is not gradual, it is sudden, it is nonlinear, and it is the reason regulators do not wait for the stress to become visible before they act. OSFI saw this convergence building. They saw trade disruption accelerating at the same time that their internal review of bank liquidity profiles revealed over-reliance on the exact funding instruments that behave worst under cross-border stress. And they moved quietly, technically, before the public had any reason to ask questions. This is the detail even analysts tend to miss. Now, let me connect this directly to what it means for the retirement savings and wealth preservation decisions of ordinary Canadians, because this is not just a story about bank regulation. This is a story about the assumptions baked into every financial plan that every Canadian household is currently operating under, and how those assumptions are being quietly invalidated right now. Here is the reality that most people won't act on until it is too late. The standard Canadian retirement strategy rests on 3 pillars. A diversified portfolio managed through a bank-affiliated wealth management platform. A mortgage that represents the largest single asset on the household balance sheet. And a combination of government and employer pension income expected to cover basic living expenses in retirement. All 3 of these pillars have direct exposure to the funding dynamics OSFI just moved to address. The portfolio is exposed through fixed income holdings, structured products, and bank-issued investment instruments. The mortgage is exposed through the repricing of bank funding costs that flows directly into renewal rates and variable rate structures. And the pension, whether it is a defined benefit plan, a defined contribution plan, or a personal RRSP, is exposed through its allocation to Canadian bank bonds, bank preferred shares, and financial sector equities that make up a substantial portion of every major Canadian index fund. For the average household, this means all 3 legs of their retirement strategy are sitting on the same foundation. And that foundation just received an emergency regulatory intervention. Here's what that looks like on the ground for a specific person. Consider a Canadian in their early 60s. They have $400,000 in their RRSP managed through one of the Big Six's wealth management divisions. Roughly 40% is in a balanced bond allocation. Canadian government bonds, some provincial bonds, and a meaningful exposure to Canadian bank bonds and covered mortgage instruments. 30% is in Canadian equities, heavily weighted to financials, as almost every TSX tracking fund is. The remaining 30% is in a combination of structured GICs and a principal protected note that matures in 2027. This person has done everything right. They followed the advice, they diversified, they held through volatility. And yet every single layer of their portfolio has direct exposure to the funding mechanism that OSFI just said needs emergency reinforcement. Their bond allocation will reprice as bank funding costs rise. Their equity allocation will face margin pressure as net interest income compresses. And their structured products are sitting in instruments that OSFI has now formally classified as carrying higher liquidity risk than previously acknowledged. They don't know any of this. Their advisor hasn't called. The bank's app looks exactly the same as it did last week. And this is precisely the mechanism that makes the eventual impact so severe. Not because the loss happens overnight, but because the exit doors are already being quietly repositioned before the average investor realizes they need to move. But that's not the real problem. And here is where the psychology matters as much as the mechanics. The reason most Canadians will not act on this information has nothing to do with intelligence. It has everything to do with three specific mental patterns that are almost universal among retail investors and retirement savers, and that the financial industry has no incentive to help them overcome. The first is normalcy bias. Canadian banks have been among the strongest, most stable financial institutions on the planet for decades. They survived 2008 without a single failure. They maintained dividends through COVID. They have a reputation for conservative management that is entirely well earned over a very long period of time. And that reputation is exactly what makes the bias so dangerous right now, because the brain looks at that history and says, if the big six were going to have a liquidity problem, it would have happened already. It didn't happen in 2008. It won't happen now. And so the regulatory signal, the actual evidence that something has changed, gets filtered out as noise. This is where common sense actually becomes your enemy. The second is the money illusion. A Canadian who opened a market-linked GIC at their bank 3 years ago and sees the account value sitting stable in their online portal feels wealthy. The nominal number has not changed, but underneath that number, the funding structure supporting that product has been reclassified by the regulator. The cost of the guarantee embedded in that product has risen. The economics of the instrument have quietly shifted, and yet because the number on the screen looks the same, the brain registers no loss, no risk, no urgency. The third is narrative control. When a major Canadian bank reports earnings and describes its funding environment as well managed and within regulatory guidelines, that language is technically accurate and completely misleading at the same time. It describes the current state of compliance. It says nothing about the direction of travel. It says nothing about the fact that achieving that compliance now requires more expensive, more stable, more constrained forms of funding. And when a financial news anchor describes OSFI's LAR update as a routine regulatory refresh, they are not lying. They are managing your emotional state so that you remain a calm, non-withdrawing depositor while the structural adjustment happens around you. Here's the part they never put in the official reports. The only question that actually matters for every Canadian with retirement savings, a mortgage, or a portfolio tied to the Canadian financial system right now is this: do you understand what you actually own and how that ownership is structured under stress? If you hold a market-linked GIC or a principal-protected note through your bank, you do not own a simple deposit. You own a structured contract whose liquidity profile has just been formally reclassified by OSFI as carrying higher runoff risk. If you hold a Canadian bank bond inside your RRSP's fixed income allocation, you own a debt instrument whose pricing will be directly affected by the rising cost of bank funding. If you hold a balanced mutual fund through a bank-affiliated advisor, you own a product with significant financial sector concentration, and that concentration is now exposed to margin compression that the fund's marketing materials never anticipated. In every period of financial stress in history, The investors who preserved their wealth were not the ones with the most sophisticated charts or the highest performing funds in the preceding years. They were the ones who understood the difference between the appearance of stability and the actual structure of what they owned. They were the ones who asked the question before the stress became visible, not after. And this is the moment to ask that question, not because Canadian banks are going to collapse, not because your deposits are about to disappear, but because a regulatory intervention of this specificity, targeting these exact instruments at this exact moment of geopolitical and trade stress on a timeline this compressed, is a signal that the system is being stress tested in real time. And the institutions that understand that signal are already adjusting their liquidity positions, their portfolio allocations, and their funding structures. The retail investor, the pension member, the RRSP holder, the household managing a mortgage renewal in 2026 deserves to understand that signal too, not to panic, not to make reckless decisions, but to ask their advisor the right questions, to understand what their structured products actually are, to know what portion of their fixed income allocation carries direct exposure to bank funding costs, to recognize that wealth preservation in this environment is not passive. It requires understanding the system you are actually invested in. This is not theoretical. This is already in motion. OSFI didn't fast track this update because the system is strong. Strong systems don't require emergency reinforcement timelines. They didn't target structured notes and brokered deposits because those instruments are irrelevant. They targeted them because those are the exact instruments that amplify liquidity crises when they hit. And because they saw enough in the actual funding data of Canada's largest banks to conclude that the buffers around those instruments needed to be rebuilt before the pressure became public. The window to understand this, the window to ask the right questions, review the right accounts, pressure test the right assumptions in your retirement and wealth plan, that window is not months long. It closes on May 1st at the regulatory level. And in the markets, it has already begun closing. They will call it a routine update. They will frame it as prudent regulatory hygiene. They will point to Canada's strong banking track record and remind you that the Big Six have never failed. And all of that will be technically true and completely beside the point, because the system didn't stumble. The regulator saw it approaching the edge of a funding cliff that the public wasn't supposed to notice, and quietly, technically, on a compressed timeline, moved to pull it back. You now know what the update actually means. You now know the mechanism it is responding to, and you now know how that mechanism connects directly to your retirement savings, your mortgage exposure, your portfolio risk, and your ability to preserve purchasing power through the disruption that is already unfolding. In the next episode, we are going to look at what happens when the LIR buffer building phase collides with Canada's mortgage renewal wall. The $2 trillion in Canadian mortgages coming up for renewal between now and 2027, and how that convergence creates the single largest systemic risk event in Canadian financial history that almost no one is currently pricing into their retirement plan. Stay informed, understand what you own, and above all, know the difference between what the system tells you it holds and what it actually holds when the pressure arrives.